Today, we're going to be talking about DTI, or debt-to-income ratio. Your debt-to-income ratio, or DTI, is an indicator of your overall financial health. The less debt and more income you have, the healthier your overall financial standpoint will be. Before we jump into it, make sure to like and subscribe to our page. Also hit the notification button. It helps us continue to bring great content to you. So now that you've hit subscribe and turned on your notifications, let's jump right into it. What does DTI stand for? DTI stands for debt to income, and it's literally exactly what it sounds like, your debt to income ratio. It's the accumulation of all your bills, your mortgage, your auto loan, etc., added together to form a ratio to your income. Let's look at an easy example to better understand this. Let's say in a month your total debt is $1,000. So for that month, you pay $1,000 in bills. Now let's say your income is $10,000. So your debt to income ratio would be 1 to 10. For every $10 you make, $1 goes to your debt payments. We could also look at it not simplified if that helps you understand it better. So with the example, we used your debt to income ratio would be 1,000 to 10,000. More often than not, you're going to see the ratio simplified, so it's important to understand they mean the same thing. You can also see DTI looked at as a percentage. In our example of 1 to 10, 10% of your income goes to debt. So your DTI would be 10%. They all mean the exact same thing, which is why that in a month you make $10,000 and spend $1,000 on your debt. Where is DTI important? DTI is vitally important. It's used by all kinds of lenders when you apply for a loan. It's also important to understand your own budgeting, but we can touch on that later. When you apply for a home loan, auto loan, or even sometimes when you apply for a lease, lenders will want to know your DTI to ensure it isn't too high. They want to be able to ensure that you can pay the amount and aren't taking on too much. In the scenario we used earlier, with our monthly income of $10,000 seems like a lot of money. And let's say you're looking to buy an additional house and your mortgage would be $1,300 a month. Well, your income says you can easily afford that, but if your debt to income ratio is over 10%, like let's say 70% for this example, can you still afford the mortgage? Probably not, and banks will not want to take the risk lending to you. You'll have to look to pay down your DTI before reapplying for a loan. Is there anywhere else where DTI is seen instead of buying a home, like credit score, loans, etc.? Medical debt and DTI will not affect your credit score, but it is important to know that if you have a high DTI, it will be more difficult to pay off bills. If you've raked up a high number of credit card bills, it will be difficult to continue to make payments, and missing or having a late payment can drastically affect your credit score. Try to keep your DTI lower to ease your financial stress. If you're looking to buy a car, they use something similar to DTI, but it's called PTI. It's essentially the same thing. PTI stands for payment to income, and it's used to calculate an applicant's creditworthiness. Typically speaking, PTI won't give lenders a complete picture of your DTI, but will give them enough. All your PTIs are added together to get your DTI score. It can sound confusing, but just remember, a car payment looks at PTI, or payment to income, and mortgage lenders look at DTI, debt to income ratio, which is a complete overview of your financial situation. What is a good DTI? DTI can be tough to get into a good spot. We've all been young and dumb with credit cards, but it's important to keep your DTI under control. Different banks and lenders have different rules for lending. A typical good score for DTI is 35%, meaning 35% of your income is going to paying the debt. A good number of banks will have a 45% rule where they won't lend to someone with a DTI over 45%. Some banks have other rules, and it's important to check and understand. You'll be wasting your time applying for a loan if your DTI is 60% and your bank has one of these thresholds for lending. For auto loans and PTI, it's a little different. They won't go as high as 45%. So while you might be able to have a DTI of 45% and get a home loan, most auto lenders won't go over 20% for your PTI. This makes sense considering PTI is not a whole overview. So lenders will cap the amount they are willing to lend you at 20% of your monthly income. This ensures that they know you are able to pay your bill and won't forfeit the loan. Why do I need a low DTI? The debt-to-income ratio is the percentage of your gross monthly income that goes to paying your monthly debt payments and is used by lenders to determine your borrowing risk. A low debt-to-income ratio demonstrates a good balance between debt and income. Conversely, a high DTI ratio can signal that an individual has too much debt for the amount of income earned each month. Typically, borrowers with a low debt-to-income ratio are likely to manage their monthly debt payments effectively. As a result, banks and financial credit providers want to see low DTI ratios before issuing loans to a potential borrower. What if my current DTI is too high? The simplest way to decrease your DTI is to make more income. With a higher income, your DTI will drop. That's not always the easiest answer, so there are many other ways. The other way is to try to pay off some of your debt or lower the payments. If you can talk to your lender and potentially refinance the loan or pay off a portion if it's mostly credit cards, you'll be in a better spot. If every month your credit card bill is $2,000, try paying off more and bringing it down to $1,000 or $1,500. You can also try to pick up a side hustle to try to earn more money and increase your income. The DTI ratio can also be used to measure the percentage of income that goes towards housing costs, which for renters is the monthly rent amount. Lenders look to see if a potential borrower can manage their current debt load while paying their rent on time, given their gross income. So if a lender is telling you that they don't trust you can make your payment, try paying off some debt and then reapplying for a loan. How is DTI calculated? DTI is calculated by combining your monthly bills. Let's see an example to make this really easy. Let's say Sam has these bills: mortgage $2,000, car $750, credit cards $1,000. Now let's say Sam has two jobs and monthly his jobs pay him job 1, $8,000, job 2, $2,000. Sam's debt to income would be debt $2,000 plus $750 plus $1,000 equals $3,750. Income $8,000 plus $2,000 equals $10,000. $3,750 by $10,000, or 37.5%. Sam's debt-to-income ratio would be 37.5%. So from what we learned earlier, he would be an attractive client for lenders because his DTI is below 40% and close to the 35% that is very attractive. So to wrap everything up, your DTI, or debt-to-income ratio, is the relationship between your debt and your income expressed in a fraction or as a percentage. The percentage is what percentage of the income is going towards paying off debt. DTI does not affect your credit score, and auto lenders will run a similar score with PTI, which is payment to income. Lenders will want you to be under 45% for a loan, but the closer you are to zero is obviously better.